When people said cash is king a year ago, I mean, that's crazy. I mean, cash wasn't producing anything, and it was sure.
There's nothing magic. We like to put a lot of money in things that we feel strongly about. And that gets back to the diversification question. We think diversification, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. It's conventional practice, and if all you have to achieve is average, it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own 1 stock, but it's a business I know, and it leaves me very comfortable. Do I need to own 28 stocks in order to have proper diversification? It'd be nonsense. 3 wonderful businesses. It's more than you need in this life to do very well. The average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business.
Much of what is taught in modern corporate finance courses is twaddle.
He said that growth and value, they're indistinguishable. They're part of the same equation, or really growth is part of the value equation. So our position is that there is no such thing as growth stocks or value stocks, the way Wall Street generally portrays them as being contrasting asset classes. Growth usually is a positive for value, but only when it means that by adding capital now, you add more cash availability later on at a rate that's considerably higher than the current rate of interest. So we calculate into any business we buy what we expect to have happen in terms of the cash that's going to come out of it or the cash that's going to go into it. So if you tell me that you own a business that's going to grow to the sky, and isn't that wonderful, I don't know whether it's wonderful or not until I know what the economics are of that growth, how much you have to put in today and how much you will reap from putting that in today later on. And the classic case, again, is the airline business. The airline business has been a growth business ever since, that Orville took off. But the growth has been the worst thing that happened to it. It's been great for the American public. But the growth has been a curse in the airline business because more and more capital has been put into the business at inadequate returns. Now, growth is wonderful at See's Candy because it requires relatively little incremental investment to sell more pounds of candy. So it's growth, and I've discussed this in some of the annual reports. Growth is a part of the equation, but anybody that tells you ought to have your money in growth stocks or value stocks really does not understand investing. Other than that, they're terrific people. The real point is that we're trying to put out capital now to get more capital, or money. We're trying to put out cash now to get more cash back later on. And if you do that, the business grows, obviously, and you can call that value or you can call it growth, but they're not 2 different categories. And I just cringe when I hear people talk about now it's time to move from growth stocks to value stocks or something like that, because it just doesn't make any sense. We would never have cash around just to have cash. I mean, we would never think that we should have a cash position of X%. And frankly, I think these asset allocation things that tacticians in Wall Street put out, about 60% stocks and 30%, we think that's total nonsense. So we want to have all our money working in decent businesses, but sometimes we can't find them, or sometimes cash comes in unexpectedly, or sometimes we sell something, and we have more cash around than we would like. And more cash around than we would like means that we have 10 or 15 cents around, because we want money employed, but we'll never employ it, just employ it. And you will find us quite unhappy over time if cash just keeps building up. And I think one way or another we'll find ways to use it.
It's a temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but you do not have to be able to play 3-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Because this is not a business where you take polls, it's a business where you think. And Ben Graham would say that you're not right or wrong because 1,000 people agree with you. And you're not right or wrong because 1,000 people disagree with you. You're right because your facts.
We think the best way to minimize risk is to think. And the idea that you have, you say, I've got 60% in stocks and 40% in bonds, and then have a big announcement, now we're moving it to 65-35 as some strategists or whatever they call them in Wall Street do. I mean, that has to be pure nonsense. I mean, 60-40 or 65-30, it just doesn't make any sense. I mean, what you ought to do is have your default position is always short-term instruments, and whenever you see anything intelligent to do, you should do it, and you shouldn't be trying to match up with some goal like that. I found it entertaining. I was just reading yesterday an article, I think it was, about the two fellows at Google and all of the problems they're going to have because they're each going to get a few $1 billion. And I mean, it was. I mean, I wanted to send a sympathy card. I almost went down a Hallmark store because this article went on. They've got this terrible problem and that terrible problem, and they're going to need lawyers and they're going to need financial lawyers. They don't need anybody. Those guys are smarter than the people that are coming to them, and they do not have a big problem. And they're very capable of thinking it through themselves. The people that have the problem are the people who want to sell their services to them and are going to have to convince them that they have a problem. But so much of what you see when you talk about asset allocation, it's just merchandising. It's a way to make you think that if you don't know how to determine whether it should be 60-40 or 65-35, that you need these people. And you don't need them at all in investing. I mean, most of the professionals that tell you you're going to get in great trouble unless you listen to them and sign up for their services, they're good at selling. But it's what my brother-in-law, former brother-in-law that worked at the stockyards used to say, was that people would bring in cattle or something, and I'd say to them, how do you get the farmer to employ you to sell the Swift or Armour or Cudahy instead of the guy right next to you? I mean, it's a cow is a cow, and Armour's going to buy it the same way. And he gave me this disgusted look, and he said, Warren, it's not how you sell them, it's how you tell them. Well, there's a lot of that in Wall Street.
Yeah, people have always had this craving to know the future. The king used to hire the magician or the forecaster, and he'd look in sheep guts or something for an answer as to how to handle the next war. And so there's always been a market for people who reported to know the future based on their expertise. And there's a lot of that still going on. It's just as crazy as when the king was hiring the forecaster who looked at the sheep guts. And people have an economic incentive to sell some nostrum. It can be sold over and over and over again. The really interesting figures are when you combine the underperformance of the market, say by the mutual fund industry, which is probably a couple of points per annum, that understates it. Now, if you take all of the investors in the mutual funds who are constantly whipsawing from one fund to another by a bunch of brokers who want commissions, now you take a subnormal performance and it goes down another 3 or 4 percentage points due to the shuffling of the mutual fund investments. So the poor guy in the general public is getting a terrible result from contacting the experts. And these guys are heading the scout troop and the community chess drive and are locally reputable people. I think it's disgusting. It's much better to make a living by being part of a system that delivers value to the people who are buying the product. But nobody refrains from creating gambling casinos or something on my theory. If it'll work to make money, well, we tend to do it in this country.